Global trade is plunging. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, get ready as we're seeing signs that a globally synchronized recession has already started. And I'm going to show you why, that even though the data doesn't confirm it yet, that this recession is coming to America. Now, what I want you to understand about global trade is how critical it is to the global economy, because when trade is expanding, well, what you see with some follow through is the global economy expands. So anytime you see data that's just the opposite, where you see a slowdown in global trade, well, it means the global economy is soon to follow it down. And if you see a sharp decline in global trade, well, it means a global recession is next. And that's why we're filming today from South Korea, because we want to see the early effects from this from some of the largest exporters, and we'll get to their data in a bit in the show. But before we get to that, not everyone is convinced that we're heading into a recession. In fact, many experts say the chances of one is actually getting pretty small. Here we see from Bloomberg, the U.S. recession becomes a closer call as economists rethink their forecast, because not long ago the belief was we're going to have a third quarter recession. Well, here we're in the third quarter, and well, not much of a recession yet. We're seeing some indications of a slowdown, but nothing really recessionary. And that's causing some of these experts now to say, well, maybe not the fourth quarter, or maybe not at all. Maybe we're actually going to get through this. But as I'll show you later in the show, the data suggests that it's already beginning to happen. Deutsche Bank Vice Chair of Research Peter Hooper and Fannie Mae Chief Economist Doug Duncan now say it's essentially a toss-up whether the economy suffers a recession or enjoys a soft landing and keeps growing. They'll both still believe a downturn is more likely than not. So here you can see they're being very wishy-washy. Well, we're not really sure because, well, the data kind of looks okay, and there's some indication the labor market may be pushing us through. Boy, we'll just toss a coin up and see what happens, because there's no evidence to us that there's really any kind of defining moment here, even though on this show I've shown you all kinds of data that says the probabilities of recession are far higher than many of the experts even believe. Now, Metre, on the other hand, says they're sticking by their firm's recession forecast, though he added it's getting to be a close call where they're about ready to pull off the recession forecast, thinking just may not happen. And the sentiment was echoed in Bloomberg's July survey of economists, in which estimates for gross domestic product were revised higher for the second and third quarter. However, forecasters still say there's a 60% chance that the U.S. will fall into recession within the next 12 months. Now, you might think, well, 60% odds are pretty good. In terms of recession forecasting, they're terrible. It means there's no chance of recession. They're effectively saying there might be. In fact, we think at 60%, the margins here are actually pretty thin. If we don't have one by the fourth quarter, it means we actually escaped it. The Fed pulled off the holy grail of monetary policy. They actually brought rates up. They slowed the economy down, but not too much. They did what seemingly is the impossible, but did they? Even Duncan said the housing starts and home prices have been stronger than expected, providing the economy with support. They also referenced the strength of new automobile sales. So here you can see again, it says, well, you know, the economy is slowing down a little bit, but look at housing. It's still strong. It's still running pretty good. There's not a lot of supply. Well, look at auto sales. They're doing all right too. Of course, what's helping that is we actually have some new cars to sell, because there for a while we didn't have any. Same problem with new homes. We talked about that in the show the other day. Builders are saying we don't have enough supply to meet the demand. So looking at, you know, those kind of shortfalls are really not good indicators of the economy, but for economists and experts, they're saying that could be all we need to keep from going into a recession. Paradoxically, Hooper credits the Federal Reserve's steep rate hiking campaign. Now, I do not get this at all, for the reduced risk of recession. In fact, I could argue, and I will make the case, that a steep rate hiking campaign does lead to recessions. Of course, many of you know that because that's what causes a yield curve to invert, but we'll get to that in a moment. I just want to say I do not agree with this guy's view at all. And that's helped re-anchor inflation expectations, increasing the chances pressures can ease, or price pressures can ease without a meaningful decline in the economy. In fact, we've shown and we've talked about this on the show that when inflation is rising, it tends to go along with the economy expanding, or even if inflation is rather moderate. But when you have a slowdown, when you see disinflation and a sharp decline in inflation like we're seeing, it generally indicates the economy is starting to shrink or slow down, and that puts it in position of a recession. And yet the experts can't see that at all. But yet here we can see in this chart here, the Fed being responsible for all of the problems, or at least ignoring the reality, as we look at the federal funds rate in blue. And here we can see these steep hiking cycles that the Fed goes through, this one being one of the most aggressive on record, if not the most, since the 1980s. And what do we know? The yield curve gets inverted here, and you see it happen in the mid to late stage of every Fed rate hiking cycle, because what happens here is the long end of the curve, we're talking the 30-year bond, the 30-year interest rates, start to say that, hey, you know what? We don't think the economy is going to see the growth and inflation expectations the Fed does. And rather than just let the bond market decide where the front end of the curve should be, the Fed says, look, we're going to artificially drive rates higher, and we don't care what the rest of the bond market says because we know better. And that knowing better, well, turns out that they really don't know at all, because they end up inverting the yield curve, and that means banks aren't profitable at that level when they lend. That leads to less money growth, and in turn, eventually, which is why the yield curve is a terrible timing mechanism, always leads to a recession. But this time, as you're seeing, experts are saying, you know what? We don't think the yield curve matters at all, even though it does. Economists surveyed by Bloomberg are growing more optimistic as inflation cools. The Personal Consumption Expenditures Price Index, the Fed's preferred inflation metric, is seen rising 2.2% in the final quarter of 2024, according to the July survey. And now we look at this. They took a survey of 73 economists, and that was looked at just after the CPI report showed inflation rates slid in June to more than a two-year low, which prompted many traders to bet the next week expected interest rate hike by the Fed will be the last of the cycle. Of course, we know it's going to probably be the last at some point, because there is a point where we'll see the consumer price index fall below 2%. And there will be a lot of people, including pressures from the White House, you'll hear it from Congress, you'll hear it from everyone else saying, hey, look, Fed, you've done enough. We know you reset the bar to the core CPI, but hey, give it a break. You got inflation down. Stop it before you cause a recession. And here's the evidence of all we need to know is why inflation's coming down is because of the strong relationship between the consumer price index and U.S. regular all formations gas price, both shown on a year-over-year rate of change. And here we can see U.S. regular all formations gas price is putting us at a level where inflation should be around maybe 1.5%, well below the Fed's 2% target. So what we're likely to expect here in the months to come is a continued sharp decrease in the headline CPI and a continued gradual decrease in the core CPI, which is why many traders are now thinking, hey, you know what? That's going to be enough for the Fed to make one more rate hike and then give the time for the economy to show that inflation is coming down, and when it does, they're done. The Fed is likely to skip September after a July hike. I'll agree with that. The next opportunity in November will likely take place against the background of recession as real rates become more restrictive. Philip Murray, the senior U.S. strategist at Rabobank, recently said, therefore, we do not expect the second hike in the dot plot to materialize. Well, Philip, I'll tell you what, you should never buy into the dot plot. It's one of the worst things the Fed puts out because it's so grossly inaccurate. They never follow. In fact, if you charted the dot plot against the federal funds rate, you would see there's really no correlation between actual policy and projected policy. But there's one thing he's right about, is that we're likely to be in a recession somewhere in the fourth quarter. Now, we did think the third quarter was a possibility, but we're not over yet. And here we can see one of the other reasons we know that inflation is coming down rapidly. As we talk about, again, money creation in a debt-based economy is critical. We know that inverted yield curve, as long as it stays inverted, banks tend to not want to lend. Of course, if the Fed's hiking next week, that's going to put further pressure on the yield curve to be deeper in its inversion. And that means banks are going to continue to tighten lending standards, as we see here in blue, showing the net percentage of banks tightening lending standards to commercial industrial loans of firms of all sizes. And anytime you see that blue line above the horizontal black line, whether it's going up or down, it means banks are tightening. It means if it's going up, they're tightening at a faster rate. It's down, they're tightening at a slower rate. You put that up against the consumer price index, and you start to see that notably, every time you see banks tightening lending standards, inflation eventually rolls over and comes crumbling down. You see it during the dot-com bubble. You see it during the global financial crisis. It happened even during the pandemic, but we'll just say that was a one-off reason. But look what's happening now, and it comes down to a simple issue here: supply and demand. You have demand for goods and services, but if people don't have the money to go and buy them, of course, where do we get money in a debt-based economy? We get it when banks lend, when banks stop lending, and people have to pay down on their, continue to pay on their loans. Of course, as we know, principal payments get destroyed when people pay their loan back, and that means less money in the economy, less money for inflation. That's why you always get a slowdown here, even though the experts are saying, nah, we're not really convinced. Well, they should be. And China's worse than expected export deal mean a new blow to the economy now as we look around the world to start to figure out what's going on with global trade, looking for a potential slowdown here to see if there's evidence the global economy is slowing. Well, we have that in China. But one thing that should not be experiencing a big blow is your trading account. What you should be seeing is it go to new highs. Let's recap our recent trade call from our CTA-Timer Pro report. It said soybeans, and I got a lot of feedback. People said, I've never traded soybeans, but I did. I got the report. I signed up. You said, hey, you put out these notices that said, hey, look, you put soybeans on your watch list because this thing is going down a bunch. At some point it reverses. This was the day, June 9th, put the trade in. We'll show you on the report, and I always recommend throw a stop loss under here at whatever level you're comfortable with and ride the thing up. If it rallies, buying more. It's still up. Even as of today, it's still up over 15% on that trade. Here you can see on July 8th, the machine positioning, which is what our report does. It looks at how the machines are positioned in the market and then runs a secondary historic overlay to tell you when it's at an extreme position, either to the upside or downside. And if you're a long trader, you'll want to find those downside positions and look for a reversal. Where there you got it on 6-9 when our fast algorithm, which runs a little bit quicker than a slow one, said, hey, the signal's reversing here. That was your opportunity to put in a trade. There is a 30-day money-back guarantee. Link in the description. It's $30 a month. As you can see, one trade, and I get all kinds of feedback. People say, man, Steve, I've been making more successful trades since I signed up with your report than anything else. Check it out. Now let's head back to China. The country's exports fell 12.4% in dollar terms in June from a year earlier, the Customs Administration said. That was the second straight month of declines and the biggest drop since the pandemic hit of the early 2020. Imports also slumped 6.8%. So here you see China, the world's largest exporter. You see their exports dropped 12.4% in dollar terms. You start to think about what that means for the global economy. Are we seeing expansion, or are we starting to see a slowdown? At 12.4%, you're almost looking at a pretty big contraction because it's a fairly large number here. So we're seeing a contraction in exports from the world's largest exporter, telling you where demand from the world's largest importer, the U.S., that must be down as well. And of course, that translates into nothing but deflation. As we know, China exports deflation, the U.S. exports inflation. That's how the world works. And what we can see is import prices from all industries in China are deflating. They're negative. And you can see the relationship between China import prices to the U.S. And the consumer price index. And what you can tell is that's going to put further downward pressure, in addition to gasoline prices, on, of course, U.S. consumer prices. As many of you know, everything we seem to buy here is made in China. But it's not just China. As we move around the world now, let's go to Japan, where we see a surprise trade surplus comes with caveats for growth. Look at this. Imports dropped 12.9%. So again, internal demand in Japan is falling, but what we're looking for is external. We're about exports, because if the Japanese economy slows, does that matter for the rest of the world? Well, we've seen historic cases where it doesn't matter too much. What we're really interested in is, are we headed to a globally synchronized recession? And I think the data is saying, oh yes. At the same time, the report highlighted the vulnerabilities in the state of demand around the world and pointed to risks for Japan's growth prospects. If you look at the details, it's not necessarily a bright situation. On a single-month basis, there's a slight recovery, but exports, get this, to the U.S. aren't clearly in an upward trend, telling us demand is slowing down. This is a problem for the global economy. Exports to the U.S. and Europe rose 11.7% and 15% respectively, while exports to China fell by 11%, the most since January, as the world's second largest economy, being China, continues to sputter. This is a problem, casting a cloud on the prospects for global growth. The pace of China's economic expansion trailed expectations in the second quarter, due in part to a slowdown in consumer spending, not a good sign. And exports actually fell in terms of volume, this from Japan, which means exports won't necessarily be a boost to GDP. Imports are falling on the back of dropping oil prices, but it's hard to imagine that the global economy, here you go, will gain momentum in the near future. Again, if it doesn't gain momentum, then the opposite starts to happen, particularly as all these central bankers, and it's not just the Fed, continue to invert yield curves and curtail money growth. But now let's head over to South Korea, where we're filming from right now. As South Korea's early export slump hitting global rebound hopes. Check this out. Daily shipments dropped 15.2% on average for the first 20 days of July from a year earlier. While total exports fell by the same margin, chip sales slid by more than a third, and shipments to China fell by a whopping 21.2%. We're talking major declines, major evidence the global economy is contracting here. And remember all those U.S. vehicles when we were building them and they didn't have chips? Well, apparently now we've got more chips than we know what to do with. As South Korea is one of the world's largest exporters, why we care about them is just the same reason we care about China, shipping a wide range of goods that makes its trade data a key indicator of health of the international economy. Global activity has been restrained by high inflation and rising interest rates. In Korea, shipments have been declining since late last year. There's a sign. As semiconductor prices have slid and demand from China weakened, there's that internal demand not only from China, but also the fact that they don't have demand from the rest of the world. The slump seemed to be showing signs of bottoming out in June when Korea reported its first trade surplus in 16 months. But now it's coming to America as U.S. leading indicators point to a recession starting soon. So here I wanted to start out the show showing you the experts are saying, look, we're not convinced, flip a coin, maybe roll some dice, and maybe we'll have a little bounce here. But hey, everything looks pretty good. And yet the U.S. leading economic indicator, well, it's saying recession is indeed coming. An index designed to track turns in U.S. business cycles fell for the 15th straight month in June, dragged down by a weakening consumer outlook and increased unemployment claims, marking the longest streak of decreases since the lead-up to the 2007-9 recession. The Conference Board said on Thursday its leading economic index, a measure that anticipates future economic activity, declined by 0.7% in June. Taken together, June's data suggests economic activity will continue to decelerate in the months ahead. The Conference Board reiterated its forecast that the U.S. economy is likely to be in a recession from the current third quarter to the first of 2024, saying they believe we're in a recession now, if you can imagine, which I know many of you agree with. Elevated prices, tighter monetary policy, harder to get credit, and reduced government spending are poised to dampen economic growth further. But one thing is still yet to come is student loan bills will cut $100 billion from consumer spending. As we know, that starts in October as borrowers are preparing to make payments on their student loans after a 3-year pause that began in March of 2020. But get this, with the average monthly bill at about $400, many Americans will struggle to cover their bills at a time when housing costs have surged and inflation has driven up everyday expenses. So not only have we seen signs that the U.S. economy is headed into recession, we know the student loan payments are coming back, and then we zoom out to the rest of the world and we say, hey, you know what? We're not alone here. In fact, those other countries, they're seeing their economies start to decline at a much faster rate, which is what we would expect, because the problem, you always look for the exporters and then it gets to the importers. That's why we're not far off before we see our data decline too. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.